Let's start it off this way. George, what do you think the couple, one or two or three biggest, most widely held misconceptions of your fellow Americans are in regards to the things that libertarians sort of understand are universally true?
Oh, geez. I start with economics. So first and foremost would be that supply of treasuries matters. That's nonsense. It's all about growth and inflation expectations. And so you can't show me a chart, especially a long-term chart, where the supply of treasuries matters. And for a lot of the libertarians, Austrians, that's kind of their starting point. Like the premise for every single thing they talk about is that supply matters, and therefore the deficits, the budget, it's going to increase the supply of treasuries to the point where the Fed is going to have to come in and do yield curve control. They're going to have to expand their balance sheet, and then the release valve there is going to be the dollar. So that's a huge misconception.
How do you see it? Because I would say that I'm generally part of that orthodoxy.
Yeah, it's all about growth and inflation expectations. So as an example, if you go back to, you can go back to the 1950s, just look at a chart of nominal GDP, and you're going to see a strong correlation with the 10-year treasury yield.
Oh, absolutely. So in theory, the 10-year treasury yield should be the growth rate plus the inflation rate.
Well, the expectations for that. It's not going to be perfect. Yeah. It's going to be the expectation.
Exactly.
So if you look at, let's say 1980, when the 10-year treasury yield was trading, I think maybe 15%, something like that. And the national debt was about 800 billion. And now we fast forward to today where it's at 37 trillion, but yet interest rates are lower.
Right, because growth is much lower and inflation is much lower.
That's correct. But the supply of treasuries has exploded. So you really can't find a long-term period in U.S. going back, let's just say 75 years, where the supply of treasuries has actually impacted the interest rate.
I agree completely with you. I think the potential difference is if there is if the duration of those obligations is short enough, I think that you could end up with simply a raw funding problem.
No, but that's a supply side issue.
Okay, right. So I am saying that at some level, the supply side issue could interrupt the normal functioning of that market. The domestic savings in the United States, something like $5 trillion. Right. And we've got to come up with, I don't know what the exact number is today, 8 to 9 trillion in the next 12 months to roll over, which means we're going to have some foreign creditors, which I agree with you is not the end of the world. And yeah, that should happen. But all of a sudden, if we're putting tariffs on our largest creditors and they're pissed off with us, I do think it's not inconceivable that there could be a funding challenge.
Yeah, so what you have to do is you have to go back and look at why the supply hasn't mattered in the past. And that's actually a mechanical issue with the monetary system, and that's where the banks come into play. So what you're doing is you're looking at it through the lens that what most people do, and it's very intuitive, so I totally get it, where you look at buying a treasury and you're looking at the 4% interest rate, and you're comparing that to the rate of inflation in the United States, and you're determining whether or not it's going to be a good deal long term. But what we have to understand is the banks, especially when you get offshore in the Eurodollar system, they don't care about the interest rates going up. They don't care about the inflation in the United States, because what they're doing is pocketing a spread between their dollar funding, meaning their deposit liabilities, and the asset side of their balance sheet. So if they can borrow at 1% and a 10-year treasury, or let's just say a 1-year treasury, because they can match up maturity for the most part. So looking at a 1-year treasury, if they can borrow for 1 year, and they can buy a 1-year treasury and pocket a 3% spread, they're going to buy an unlimited amount. The only thing that's going to prevent them from buying that 1-year treasury is if they have a better use for their balance sheet capacity. So if
and that's why growth impacts the treasury yield so strongly. I agree with everything you're saying.
Yeah. So what happens, Porter, is so you're not going to get into a funding issue, because if the interest rates, let's say, go up to 5%. But growth in inflation roughly is 4%, then the banks are going to arbitrage that out. And they're going to go ahead and buy enough treasuries to bring that interest rate down. And the opposite is true. Let's say we have a stable coin, and that all these stable coins go out and buy treasuries. And we'll just say that growth and inflation is right around 4%. And let's say that takes the interest rate down to 3%. Well, then I think the banks are going to sell because then they're going to see that that's not a good deal, risk reward anymore. And that's why you have kind of an equilibrating process that revolves around growth and inflation. And in
all
my
good
view,
arguments.
that explains why the 10-year Treasury has tracked nominal GDP going back to, let's just say, the 1950s. And now I'm not saying that that's going to be the way it is forever. What I am saying is that's going to be the way it is until the monetary system itself changes. And when the monetary system changes, then it's a different story. But until that time, it's not going to be you could issue.
Well, you're cheating because you're just taking away the only avenue I have to argue with you. Well, it'll be this way until it's not. Okay, I got so when will it not be this way? Because my rebuttal to you is going to be like, well, then why do we bother with taxes at all? Why don't we just keep issuing Treasury bonds until the cows come home?
Yeah.
So there is a point where our creditors go, oh shit, I'm not going to get paid back, and therefore I can't continue this funding process.
But is the bank going to do that, Porter? So is the bank going to say, oh shit, I'm not going to get paid back?
Well, we've seen banks make huge mistakes with other people's money as long as we've been alive.
Right, but that's because they got a maturity mismatch. You're talking about
I'm talking about the way that they made mortgage loans to people who had no possibility of ever paying them back. Like I've seen banks extend credit to people and institutions where it made no sense, but they could still do so on a spread, and so they did.
Yeah, so but the big difference there is with the treasuries, you're going to get paid back.
Well, okay, maybe, but this is something maybe we really disagree on, because everybody says, "Oh, we'll just print more money so we won't default." But do you understand how the COLA system works and the impact of the 1975 Social Security law?
You're talking about how inflation goes up and then it adjusts higher, so the Social Security payments increase as well?
Exactly. So it's a matter of law that happens automatically based on the CPI urban consumer inflation rate, which I understand understates inflation, but it still gets impacted when we did what we did in COVID, which was print $7 trillion and put it in people's checking accounts. Like the result to the increase in the liabilities of the Social Security system was immense, something like 22% in a period of 3 years.
Right.
So there will be a default, whether it's a default to Social Security recipients or a default to foreign banks remains to be seen. Which one would you bet on? But
it's still if you're pocketing a spread, that's not taking your own money. So that's like me saying, Porter, if I gave you $150 million tomorrow, would you take it? The answer would be yes. The answer would be yes. But if I said, well, wait a minute here. What if I give you $150 million over the next year, but the inflation rate in the United States is 5%? Would you still take the $150 million?
Well, of course I would.
Okay, that's because you're pocketing a spread. And that's the same position that these banks are
No, it's because you just told me you're going to give me the money. You didn't say I had to pay it back.
Well, because you're not using your money to begin with. The banks aren't using their money to begin with.
George, I don't know everything, but I am aware of that.
Right.
What I'm saying is the bank cannot function if there is a Treasury bond default, right? If they have to write off all their Treasury bond investments, like, by the way, Bank of America should,
okay,
they're out of business.
Right. So your position is if the government just says we're not going to pay any of our bonds that are maturing, we're just going to pound sand. You guys that are holding those bonds are done. They go to zero.
Well, I think what I'm saying is very, very, very accurately is the current fiscal policy of the United States government, and it's how do you call the Social Security stuff? The
unfunded liabilities.
Unfunded liabilities.
The unfunded liabilities of that system. That those obligations cannot possibly be financed. They cannot be.
Why not?
Well, very simple reason. The present value today of the unfunded liabilities. In other words, not what we're going to have to pay someday. What we have to pay today to finance them, okay, is $30 trillion. We're already $37 trillion in debt. There is no way we're paying that money back.
Well, why not? No, not
Uh,
paying it back. I'm not talking about paying it back. I'm
because
talking
you're
about balance
saying
sheet
that you're. What,
capacity
I
for the
understand.
37 trillion.
I understand what you're saying. We'll just keep printing, and the
No, no, no,
inflation
no,
will
no.
make it go away.
I'm not saying we're going to keep printing. We don't need to
Oh,
print.
okay.
The Fed's balance sheet could decrease. It wouldn't matter.
All right. So how do you think we're going to collect enough money in taxes to
We
pay
don't.
those obligations?
No. Well, let me be clear. I'm not saying that we're going to pay off the debt. I'm saying that if you add another 30 trillion in debt to the overall debt because of the unfunded liabilities, we're not going to have a demand problem. That's we're not going to have a demand problem.
Okay. So in other words, if you put onto the Fed's balance sheet the real money that should be there from the obligations of Fannie and Freddie, and you put in the real obligations of the pension system, which should be on their balance sheet too, you're talking about, something on the order of, let's say, 70, maybe another 10, $80 trillion.
Right.
And if you had to pay an honest rate of interest, I can't do this math in my head. What's 5% of 80 trillion? I can't do that math in my head.
4 trillion.
10% would be 8 trillion.
Yep.
And
4
half
trillion.
of that would be 4 trillion.
Yep.
That's $4 trillion just in interest.
Yeah.
And again, correct me if I'm wrong, but I'm pretty sure that's more than the
Collected.
That's more than the government's tax receipts outside of the Social Security system.
Right.
So
The
I
banks,
don't. This
the
doesn't.
banks, Porter,
But you're,
the banks. So, like, Aaron,
yeah,
let me ask
but
you.
I know. I hear what you're saying. You're saying the banks, as though that's some kind of like magic wand that makes this go away. But no one is going to lend to you if you can't at least afford the interest on your debts. That's why General Motors went bankrupt. That's why Detroit went bankrupt.
What do you mean by you can't afford? That's a demand side. What you're implying that you can't afford is that there's not going to be demand for those treasuries. And what I'm saying is that the demand is going to be there because the banks like free money, that the banks aren't going to become less greedy. So if I, as an example, go over to Aaron. So Aaron, if you can borrow at 1% and you can buy at 4% and match up maturity, are you going to buy all 30 trillion of that debt?
You're not going to buy that debt if the entity that's issuing it can't afford the interest service.
But how can you not afford it if demand is unlimited?
I'm talking about the interest payments that must come from the U.S. Treasury.
How are they going to get it? They're going to get it by issuing more bonds. And if the demand for those treasuries is there, they're going to be able to afford the payment.
George, you've completely lost me. I don't understand the way that you think that that the Treasury can borrow infinite amounts of money simply based on the current spreads. I think that what would happen very quickly is that there would be a risk premium that gets priced into those bonds.
But what is the risk?
That would drive the spreads away.
But if let's just assume for a moment that demand is there. What's the risk?
Well, the
What's
risk
the risk
is
to the bank?
the risk is like in every other one of these situations, like at Greece, like has happened in Russia. The risk is suddenly one day the market wakes up and goes, "Oh, that's really stupid. We shouldn't be doing that anymore."
Why would the market do that if it's free money, Porter?
Well, because it's
That
not
spread is
free money, George.
That's like saying Aaron's going to wake up,
But
one
only
morning
if
saying, I don't want that
only if the
3%
Treasury.
on 30 trillion anymore.
I got it, but not if the treasuries are no longer credit worthy.
But you're assuming
Okay, just look at your argument. Why, for example, then don't the banks own nothing but low quality junk bonds? They have a much higher spread.
because the risk reward doesn't make sense, because the risk reward right now,
There
due
you
to the
go.
fact the overall global
There you
economy
go.
doesn't
So
make
in other
sense,
words,
that's why they're going into treasuries.
Right. The risk is that the Treasury will default, and you're saying that risk doesn't exist, and
But
I'm
the-
saying it does. That's
but
all.
But no,
You might be right. I might be right. I can't know. But what I do know is that the way we have been financing our government for the last, 50, 60, 70 years is by pretending that these debts don't come due and that we can inflate them away. And
Okay,
that's been working for a very, very long time.
why has it been
But
working, Porter?
in
Porter, why has it been
75,
working?
the change to Social Security law really sets us up for a decision at some point, maybe in 10 years, maybe sooner, maybe later, but not infinite, where we're going to have to decide who we want to default on.
Porter, okay, let's define default. Are you talking about default in terms of inflation or default in terms of being paid back?
I just don't think you recognize that there is no solution through inflation, that we cannot inflate away the roughly $100 trillion that we owe to the recipients of Social Security.
Yeah, I'm not arguing that.
Okay. Well, I'm completely
I'm
lost
arguing
now.
that there's going to be a bid for treasuries no matter what the debt is. There's going to be a
disagree
bid for
with you.
treasuries.
I completely
So
disagree.
what
with
you're arguing is that banks don't want free money. And
you.
if
No,
that's your
I'm
argument,
arguing.
that's fine.
I'm arguing that in a marketplace, the risks of default eventually get priced in. I
But
can't
what
tell you when.
if you're buying a 1-year treasury and you
Yeah.
borrow for 1 year to buy
Yep.
that treasury,
Yep.
what is your risk, Porter? Help me understand that.
The risk is that the Treasury defaults and that it does not
And that
repay me my principal.
they don't pay you the principal.
That's right.
So what scenario would you lay out where the government would just say, you know what, we're not paying you anymore?
All kinds of scenarios. What happened to the government in Greece?
Can they print their own money?
Well,
No, they're
sort
on
of.
the euro.
They're a member of the
The
euro.
US can print their own money.
By the way, they did essentially print their own money because they didn't pay their creditors back.
Right, but they can, but you see what I'm saying? The U.S. is not going to now there might be inflation. Now,
I
don't
hear
think
you
they
loud
can
and clear,
create
but
inflation.
again, you keep discounting the fact that we can't print the money to pay off Social Security and Medicare. We can't.
But why not?
Because every year the price of that gets reset by law automatically. And can you imagine Congress voting to change that?
So you're
No
saying
way.
you're saying there's a limit on the Fed's balance sheet.
Yes, there definitely is.
Okay, help me understand where that limit and why is there a limit on the amount of QE the Fed can do?
Because that QE translates into inflation, which then gets priced in
It doesn't. It
to
doesn't.
a debt obligation that's actually almost as large
This
as our current total national debt. So in other
But
words, yeah, you're making the $37 trillion that you owe financeable because you're printing money to pay for it. Yep, and I agree with you. That debt can grow to infinite. I get you. But you can't grow the other obligation you owe, which is also currently $30 trillion. And so every time you do that, every time you print 10% more money to pay off the foreign creditors and the holders of the domestic holders of Treasury bills, you're increasing the value of what you owe the other side by almost the same amount. And soon it will be more.
What's the correlation
And as soon as it's more, then you're just digging yourself in a bigger hole.
What's the correlation between the size of the Fed's balance sheet and the CPI?
What's the correlation between the size of the Fed's balance sheet and the CPI? No correlation at all.
Correct. So why do you assume if the Fed buys treasuries, there's going to be inflation?
I'm assuming that when the Fed buys treasuries, by the way, like they did during the banking crisis, it didn't create any inflation at all. But what they did with COVID created massive amounts of inflation.
No,
Because
but let's dissect that.
because they didn't just buy banking reserves. They put however much money it was into people's checking accounts.
The
So
Fed
it increased M2 dramatically.
Well, okay, but let's dissect that. So what did the Fed do to increase M2 specifically?
I don't remember what mechanism they used. I just know
walk
that
you through
M2.
it. So what they're doing is
I just know that M2 went crazy.
right, but it went crazy for several different reasons. Number one is people were drawing down their lines of credit because they thought the world was going to end. So what percentage of the 25% increase in M2 had absolutely
Well, just imagine if people realize that a default's coming, what they're going to do.
Right, but okay, so that's one component, right? So then you look at the Fed and what they did, but then you have to dissect the amount of QE they did and determine if they're buying from a bank or they're buying from a non-bank. Because if they're buying from a bank, it doesn't impact M2. If they're buying from a non-bank, then it does. So it's debatable as to them taking their balance sheet up to $9 trillion, how much of the impact that had on the increase of 25% M2. And then it's even further debatable as far as what that did to inflation, because you had a supply side shock. So
George, well, let's go ahead and move on to another topic, because I don't think we're going to come to an agreement
I
about
don't think
this.
so.
And here's why I'll tell you this. When somebody tells me that the sun won't rise tomorrow and they have all the reasons in the world why it won't, I still don't believe them.
no, but
I do not believe that a government can continue to function with deficits the size of ours and debts the size of ours without there being a default or some other kind of credit collapse.
okay, did Japan
Now listen,
default?
I could be wrong. I could be completely wrong.
Yeah, so
Okay, and maybe every other point in economic history is wrong. And no, Japan is not cratered yet, because Japan has enormous amounts of domestic savings. They can finance a whole lot more government debt if they want to. But
Yeah.
but listen, I believe that your premise is wrong. And so, that it hasn't happened yet, that it can technically
that's
go
not my
on for a
premise.
lot longer.
That's not my premise, Porter.
Is okay. It's okay
That's
with
not my
me.
premise.
But I think that most people's idea that the government is not subject to any fundamental credit limit will turn out to be wrong.
Okay, that's not my premise. But then B, I'd have to ask you. You could have made this argument in 1985, and people, by the way, the sound
Did.
money guys, they were making this argument in 1985. They're making it in
That's right.
1990. They're making it in 1995. They're making it in
That's right.
2000, 2005, 2010, etc. Right. So I'm not saying that just because they've been wrong for 40 years that they're always going to be wrong. But what you have to do is if you're that person, I'm not saying you are, but if you are, you have to recognize that your model has gotten it wrong in the past. So then you have to analyze your model and say, what did I get wrong? What do I need to tweak moving forward to where I better understand the situation? And to do that, you have to mechanically explain why, and you would, I'm sure, admit this, that up until this point in time, the debt has not mattered. Why? It's always about growth and inflation expectations. It's not just because the petrodollar. It's not because foreigners are.
By the way, I think it will continue to be about growth and inflation. I think that's how these bonds will be priced. But I do think that there will be an additional cost, which is a growing risk premium. And I think that you see that growing risk premium, and you see treasuries behaving in a really novel way, starting after the bank bailouts of 08 and 09. And I think that's why you saw and continue to see such a big move in gold, such a big move in Bitcoin. I think that there are more and more people beginning to question the entire structure of our government's
but
tax
to be
and
clear,
spending.
they haven't moved in a novel way. It's still pretty much pegged to growth and inflation expectations, and therefore nominal GDP.
Yeah, that's right. And I think that if the government continues to run a massive fiscal deficit, and I expect eventually our creditors will demand higher interest rates. So and by the way, that could
Eventually,
easily that could easily cause inflation.
Right, but you've got to again.
And
Let's
also,
go back.
by the way, I love the idea that people believe that these tariffs won't cause inflation. I think that's wrong too. If we had sound money, the tariffs would definitely be deflationary because there would be a huge price shock in the economy. But we don't have sound money, and so just as you know, what will happen is the government spending will simply continue to increase, even if things cost more. And so I think that there will be more inflation than people expect next year, and I expect the economy to be much stronger than people expect next year because of those factors.
Okay, I'll address that, but just going back to the point, I want to tie the ribbon on that. My position is I'm open to arguments there, of course, but if you or anyone else, your audience, wants to debate or push back on this, you have to tell me mechanically why the debt hasn't mattered up until this point. And I have never ever heard an
George,
explanation.
that's a very obvious explanation. It hasn't mattered up until this point because it's been easily financed.
By whom and how?
So I would say that debts under 100% of GDP are not routine, but they're very common in governments that can be good credits, not always.
Okay.
By the way, Colombia is the one nation in the Western Hemisphere that's never defaulted. So, it is possible that governments can have large, sound debts. But I think that the history of governments, when they get into 120, 130, 150% of GDP, the record is really not good. I don't know that there's ever been a single government that hasn't defaulted with debts at that level.
But the Treasury market is the bond market for the world. So if you want to look at it through that lens, you can't just look at debt to GDP in the United States. You've got to look at the debt, the supply of treasuries relative to the global economy. And the global economy is 120 trillion.
That's a very good argument, and that's probably one reason why we haven't had serious financing troubles. But look, just do some basic math and ask us and think about where we're going to be in terms of the annual budgets in, say, 10 years, and say 2035.
Look, I would
how's that going to be financed?
Or to be clear to you and your audience, I would probably argue that the deficits and the debt are going to be higher than you would even argue. I disagree with you that
I think the debt. I disagree with you that will not ever matter to our creditors. I absolutely disagree with you.
Yeah, so
it will. And again, I can't tell you exactly when, but it will.
But what you have to do, if that's your argument, is you have to go back and tell me why it didn't matter in the past. And the fact that the debt to GDP was under 100%, that's not a mechanical reason. That's just an arbitrary line in the sand.
Okay. Well, George, how about this? Why do you think Moody's. Why do you think Moody's downgraded America from AAA?
And what did it do to the interest rates?
It didn't change it yet. Of course it didn't.
Of course. Yeah. In fact, they started doing that when? 2012, 2014? And it didn't do anything. Yeah. Why? Because the banks don't care. They don't care. All they care about is growth and inflation and the arbitrage.
And they won't care, maybe, until all of a sudden Congress is having a debate about how we're going to default on our foreign creditors.
No, but okay.
And then it will change.
Okay. So I think the where we see things differently is I see the probability of the United States just telling everyone to pound sand and they're not going to pay their treasuries, even though they have a money printer. I see the probability of that is incredibly, incredibly low. And it sounds like you're seeing that as a high probability.
I'm seeing it as an inevitability. And the reason why the money printing solution won't work is because of the automatic COLA adjustments that we have to make on the Social Security system. In other words, we're going to start paying a higher tax on ourselves by continuing to use the money printer.
Right, but you're assuming that the Fed increasing their balance sheet leads to inflation, and we already talked about how that's not necessarily true.
No, I'm assuming that the only way that I can fathom that the government will be able to control the yield is by printing money to buy more treasuries. And I think that will lead to inflation. Yeah, yield curve control. Yes.
Okay, but again, that's all yield curve control is QE. And we established before that QE doesn't necessarily mean increased CPI.
It certainly doesn't mean increased CPI in the middle of a banking system collapse, but it sure did mean inflation and COVID. So
okay, but then you have to decipher what percentage of the 9%, let's say we got to in the middle of 22, what percentage of that was supply shock, and what percentage of that was Fed's balance sheet, when we know that the Fed's balance sheet was just only a small percentage of the MC increase to begin with.
George, I actually don't have to do that. Like I said, I know the sun will come up tomorrow. I know that if the government behaves in a way that is not creditworthy, eventually they will get their credit called.
Right, but
I also know that if you do that kind of monetization of debt long enough, there will certainly be inflationary consequences.
Well, to be clear,
we're not above the laws of physics.
Yet to be clear, well, first of all, the sun coming up tomorrow is growth and inflation expectations. That's the sun coming up tomorrow. That's what's happened for 75 years. So the sun coming up tomorrow, that's actually my argument. You know, that's
I think it's some really great metaphor jujitsu right there. And usually, by the way, that's how I win arguments. Yeah. So I applaud that. But listen, every person who makes an argument should be able to understand what the inverse of the argument is.
Well,
what you're arguing is that essentially is that our government doesn't have to be creditworthy, because it sets the world's interest rates, and because it prints the money of the world's reserve currency. And I know you're right technically.
It doesn't. First of all, it doesn't print the world's reserve currency. The United States, the Fed, it doesn't print the world's reserve currency.
Now I know what it's like when people try to talk to me.
Yeah, but Porter, but seriously.
I mean, but George is a bulldog over here.
I got it. He's got a view. He's not letting go.
No, he's not letting it go.
But to be clear, it's the banks. It's the banks outside of the United States that print the majority of dollars, and it's not green pieces of paper. It's not bank reserves. It's simply dollar credit. It's dollar credit. And we're in a global economy of 120 trillion. So you figure there's at least 90 trillion, 75 trillion of dollars that were created by the banks outside of the United States. It had nothing to do with the Fed, had absolutely nothing to do with the Treasury. And I want to also be clear that I'm not saying that the Fed will have to do yield curve control. I'd say they might do that, but I don't think they would really need to, because I don't think that interest rates would fluctuate that much above or below growth and inflation expectations because of the mechanism, which in my mind is why we have seen what we've seen for the last 75 years and why the supply hasn't mattered. Now, I want to make one thing very, very clear. I am not saying that because the United States currently doesn't have a debt problem, that we get a free lunch. I am not saying that. But the problem isn't in the bond market. The problem isn't in the Treasury market. The problem is with the government spending. This is what distorts the economy. And this is where the poor and the middle class pay for the fact that the government does basically have an unlimited credit card. So I don't want to make it seem as though I'm saying that we can just print all, or, quote unquote, we can create all this debt and we never have to pay the fiddler. No. I'm saying that we've already been paying the fiddler. We've already been paying it, because the problem isn't the Treasury market and interest rates. The problem is in the government spending to begin with and the economic distortions that it creates.
Well, there we agree.
Yeah.
There's a reason why the world's best informed investors read my daily journal. Subscribe for free at portersjournal.com.